Invest Smart, A Beginner's Guide to Building Wealth. Chapter 1. Introduction to Investing. Understanding Wealth Building. Understanding wealth building is a fundamental aspect of achieving financial independence and security. It involves a strategic approach to managing resources, where individuals learn to accumulate assets over time while minimizing liabilities. The journey begins with a solid foundation of financial literacy, which empowers individuals to make informed decisions about their money. By understanding the various components of wealth building, such as saving, investing, and financial planning, beginners can create a roadmap tailored to their unique goals and circumstances. At the heart of wealth building is the concept of investing. Investing allows individuals to grow their money beyond mere savings. This can be done through various vehicles, including stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Each investment type comes with its unique risk and return profile. For beginners, it is crucial to understand the basic principles of the stock market, such as how to read stock quotes, the importance of diversification, and the impact of market trends. By grasping these concepts, novice investors can make better choices that align with their financial objectives. Another critical element of wealth building is understanding the role of retirement accounts in long-term financial planning. Instruments such as 401k plans and individual retirement accounts, IRAs, can significantly enhance an individual's ability to save for the future. These accounts often come with tax advantages, allowing for the growth of investments without immediate tax implications. Beginners should pay close attention to contribution limits and employer matching programs, as these factors can substantially increase the amount saved over time. Developing a robust retirement strategy early on can set the stage for a comfortable and secure future. Budgeting and saving are equally vital to the wealth-building process. Creating a budget helps individuals track their income and expenses, allowing them to identify areas where they can cut costs and redirect funds towards investments. Consistent saving, even in small amounts, can lead to significant wealth accumulation over time, especially when combined with the power of compound interest. Establishing an emergency fund is also essential, as it provides a financial cushion that prevents individuals from derailing their investment plans due to unexpected expenses. Finally, understanding risk management and behavioral finance is crucial for aspiring investors. All investments carry some level of risk, and beginners must learn to assess their risk tolerance and make decisions accordingly. This involves recognizing emotional biases that can affect investment choices, such as fear and greed. By developing a disciplined investment strategy and sticking to it, individuals can mitigate impulsive decisions driven by market fluctuations. A comprehensive understanding of wealth building equips beginners with the tools they need to navigate the complexities of investing, ensuring they are better prepared to achieve their financial goals. The importance of financial literacy. Financial literacy encompasses the knowledge and skills necessary to make informed financial decisions. In today's complex economic environment, understanding the basics of finance is crucial for anyone looking to build wealth and secure their financial future. It enables individuals to navigate various financial instruments, from stocks and mutual funds to cryptocurrencies and retirement accounts. By grasping fundamental financial concepts, beginners can better assess their options, minimize risks, and capitalize on opportunities in the investment landscape. One of the primary benefits of financial literacy is the ability to create and follow a sound budget. Knowing how to allocate resources effectively allows individuals to prioritize saving and investing. A well-structured budget can help identify unnecessary expenses, enabling individuals to redirect those funds toward investments that align with their financial goals. Moreover, understanding the importance of saving for emergencies and future needs lays a foundation for financial stability, which is essential before venturing into more complex investment vehicles. Investing in the stock market, mutual funds, or ETFs requires a solid understanding of market dynamics and investment strategies. Financial literacy provides the tools to analyze stock performance, track market trends, and assess the potential risks and rewards of various investment options. This foundational knowledge is particularly important for new investors, as it fosters confidence in their decision-making and encourages a more strategic approach to investing. Furthermore, it helps demystify concepts such as diversification and asset allocation, which are crucial for managing risk in an investment portfolio. In the realm of retirement planning, financial literacy is equally vital. Understanding different retirement accounts, such as IRAs and 401(k)s, allows individuals to take full advantage of available tax benefits and employer contributions. Moreover, grasping the principles of long-term investing can motivate individuals to start saving early, thereby maximizing compound interest over time. With a clear understanding of their retirement goals, individuals are more likely to create a robust plan that supports their desired lifestyle in their later years. Finally, financial literacy plays a significant role in behavioral finance and investment psychology. Recognizing the emotional factors that influence financial decisions can help individuals avoid common pitfalls, such as panic selling during market downturns or overconfidence in speculative investments. By fostering a disciplined approach to investing, informed individuals can maintain a long-term perspective, make rational decisions, and ultimately enhance their chances of achieving financial success. In summary, the importance of financial literacy cannot be overstated. It serves as the cornerstone for effective investing and sustainable wealth building. Chapter 2. Investing for Beginners. Defining investing. Investing can be defined as the process of allocating resources, typically money, into various assets with the expectation of generating a return or profit over time. Unlike saving, which focuses on preserving capital and ensuring liquidity, investing involves taking calculated risks with the goal of achieving long-term growth. This fundamental distinction is crucial for beginners to understand, as it sets the stage for making informed financial decisions. The essence of investing lies in the balance between risk and reward, where higher potential returns often come with increased risk. At its core, investing encompasses a wide range of assets, including stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, and even cryptocurrencies. Each type of asset carries its own set of characteristics, risks, and rewards. For instance, stocks represent ownership in a company, providing potential for both capital appreciation and dividends. Conversely, bonds are debt instruments that typically offer more stable returns but with lower growth potential. Understanding these differences is essential for new investors as it enables them to construct a diversified portfolio tailored to their financial goals and risk tolerance. The investment landscape has evolved significantly with the advent of technology and the rise of digital platforms. Today, investors have access to a wealth of information and tools that facilitate investing in various asset classes. Mutual funds and ETFs, for example, allow individuals to invest in a diversified portfolio managed by professionals, reducing the burden of selecting individual stocks. Furthermore, the growing popularity of cryptocurrencies introduces a new dimension to investing, characterized by high volatility and innovative technology. As a result, beginners must educate themselves about these options to navigate the complexities of modern investing effectively. Another crucial aspect of investing is the role of retirement accounts, which provide tax advantages and encourage long-term wealth accumulation. Vehicles such as 401(k)s and IRAs allow individuals to save for retirement while benefiting from tax-deferred growth. Understanding how these accounts work and the best strategies to maximize their potential can significantly impact one's financial future. Additionally, integrating sound budgeting and saving practices into an investment strategy is fundamental. Establishing a solid financial foundation ensures that individuals are prepared to invest consistently over time, enhancing their chances of achieving their wealth-building goals. Finally, risk management is an essential component of investing that cannot be overlooked. New investors must develop an awareness of their risk tolerance and the psychological factors that influence their investment decisions. Behavioral finance highlights the importance of understanding emotions, biases, and market psychology when making investment choices. As individuals embark on their investment journeys, cultivating a disciplined approach and maintaining a long-term perspective can help mitigate the impact of market fluctuations. By defining investing in this comprehensive manner, beginners can build the knowledge needed to make informed decisions and ultimately work towards achieving financial independence. Types of investments. Investing is a crucial component of building wealth, and understanding the various types of investments is the first step for beginners. The landscape of investment options is diverse, allowing individuals to choose based on their financial goals, risk tolerance, and time horizon. The primary categories include stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, and alternative investments such as cryptocurrencies. Each type has its unique characteristics, advantages, and potential pitfalls, making it essential for new investors to familiarize themselves with their options. Stocks represent ownership in a company and can offer significant returns, particularly over the long term. When you purchase shares, you have a claim on the company's assets and earnings, which can grow as the business expands. However, investing in stocks also comes with inherent risks, including market volatility and the potential for losing principal. Beginners should consider investing in individual stocks only after gaining a solid understanding of the market and the specific companies they are interested in, or they may opt for diversified options like mutual funds or ETFs to mitigate risk. Bonds, on the other hand, are debt instruments where investors lend money to entities such as governments or corporations in exchange for periodic interest payments and the return of the bond's face value at maturity. They are generally considered safer than stocks, making them an attractive option for conservative investors or those nearing retirement. However, bonds can also be affected by interest rate changes and credit risks. Understanding the different types of bonds, including government, municipal, and corporate bonds, is essential for making informed investment decisions. Mutual funds and ETFs offer beginner investors a way to diversify without having to pick individual stocks or bonds. A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities, managed by a professional fund manager. ETFs, similar in structure to mutual funds, are traded on stock exchanges and often have lower fees. Both options provide exposure to a variety of asset classes and can be tailored to different investment strategies. Investors should research the fund's objectives, fees, and performance history before committing their capital. Cryptocurrencies have emerged as a new class of assets, capturing the attention of investors worldwide. These digital currencies, such as Bitcoin and Ethereum, offer a decentralized alternative to traditional currencies and have the potential for high returns. However, they are also highly volatile and speculative, making them suitable for only a portion of an investor's portfolio. Beginners should approach cryptocurrency investments with caution, ensuring they understand the technology behind it and the associated risks. Additionally, long-term investing strategies, including the use of retirement accounts like IRAs or 401(k)s, can provide tax advantages and help build wealth over time. Setting investment goals. Setting investment goals is a fundamental step for anyone beginning their journey into the world of investing. Goals provide direction and purpose, allowing investors to align their financial objectives with their investment strategies. By clearly defining what you hope to achieve, whether it's saving for retirement, buying a home, or funding your child's education, you can create a roadmap that guides your investment decisions and helps you stay focused on your long-term aspirations. When setting investment goals, it is essential to consider both short-term and long-term objectives. Short-term goals might include saving for a vacation or building an emergency fund, while long-term goals typically involve retirement savings or building wealth over time. Each type of goal requires different strategies and risk assessments. Short-term goals may be best served by more conservative investments, whereas long-term goals can take advantage of the potential higher returns associated with stocks and other growth-oriented assets. Understanding the time frame for each goal will help determine the appropriate investment vehicles to use. Another important aspect of setting investment goals is ensuring they are specific, measurable, achievable, relevant, and time-bound, often referred to as the SMART criteria. For instance, rather than stating a vague goal like, "I want to save for retirement," a more effective goal would be, "I want to save $500,000 for retirement by the age of 65. This clarity allows investors to track their progress and adjust their strategies as needed. Additionally, setting realistic expectations based on personal financial situations and market conditions is crucial to maintaining motivation and avoiding disappointment. Risk tolerance is a key component of setting investment goals. Every investor has a different capacity for risk, influenced by factors such as age, income, financial obligations, and personal comfort levels. Understanding your risk tolerance helps in selecting investments that align with your goals. For example, younger investors with a longer time horizon may choose to take on more risk, investing heavily in stocks or cryptocurrencies, while those nearing retirement may prefer more stable, income-generating investments. Evaluating your risk appetite will enable you to build a portfolio that supports your goals while remaining within your comfort zone. Finally, it is vital to revisit and reassess your investment goals regularly. Life circumstances can change, and so can market conditions. Factors such as a new job, changes in family dynamics, or economic shifts may require adjustments to your goals or investment strategies. By periodically reviewing your objectives, you can ensure that your investment plan remains aligned with your current situation and aspirations. This proactive approach will help you stay on track and make informed decisions that contribute to your overall financial well-being. Chapter 3: Stock Market Basics for New Investors. How the stock market works. The stock market is a complex yet fascinating system that plays a crucial role in the economy. At its core, the stock market is a platform where investors can buy and sell shares of publicly traded companies. These shares represent ownership in a company, and their prices fluctuate based on supply and demand dynamics. When a company performs well, its stock price typically rises, allowing investors to profit when they sell. Conversely, if a company struggles, its stock price may decline, leading to potential losses. Understanding these fundamental principles is essential for anyone looking to navigate the stock market effectively. One of the key components of the stock market is the exchange, where trading occurs. The most recognized exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. Companies listed on these exchanges have undergone a rigorous process to become publicly traded, often involving an initial public offering (IPO), where they sell shares to raise capital. This process not only provides the company with funds for growth, but also opens the door for investors to participate in the company's potential success. Learning about different exchanges and the types of securities they offer is vital for new investors. Investors can choose from various types of securities beyond individual stocks, including mutual funds and exchange-traded funds, ETFs. Both mutual funds and ETFs pool money from multiple investors to purchase a diversified portfolio of stocks or other assets. This diversification helps mitigate risk, making them an attractive option for beginners who may be wary of investing in individual stocks. Understanding how these investment vehicles function and their respective advantages can empower new investors to make informed choices that align with their financial goals. Another critical aspect of the stock market is the importance of research and analysis. Investors should familiarize themselves with fundamental analysis, which involves evaluating a company's financial health through its earnings, debt levels, and growth potential. Technical analysis, on the other hand, focuses on price movements and trading volume to identify trends. By incorporating both approaches, new investors can develop a more comprehensive understanding of market behavior and make more strategic investment decisions. Lastly, it is essential to recognize the psychological factors that influence investing. Behavioral finance explores how emotions and cognitive biases can impact investment decisions. New investors may experience fear of missing out, FOMO, or panic during market downturns, leading to impulsive actions. Educating oneself on these behaviors can help investors maintain a rational approach, fostering a long-term perspective that is critical for successful investing. By understanding how the stock market operates and the psychological elements at play, beginners can build a solid foundation for their investment journey. Key stock market terms. Understanding stock market terminology is essential for anyone looking to navigate the world of investing. Familiarity with key terms can enhance your ability to make informed decisions and engage effectively with financial professionals. This knowledge serves as a foundation for building wealth and achieving financial independence. In this subchapter, we will explore important stock market terms that every beginner should know, helping you to demystify the complexities of investing. One of the most fundamental terms is stock, which represents a share in the ownership of a company. When you buy a stock, you are purchasing a small piece of that company and become a shareholder. The value of your stock can fluctuate based on the company's performance, market conditions, and investor sentiment. Closely related to stocks are dividends, which are payments made by a corporation to its shareholders, usually derived from profits. Understanding dividends is crucial, as they can provide a source of passive income and indicate a company's financial health. Another important term is market capitalization, often referred to as market cap. This term reflects the total market value of a company's outstanding shares and is calculated by multiplying the stock price by the total number of shares. Companies are typically categorized as large cap, mid cap, or small cap, which can provide insights into their stability and growth potential. Investors often use market cap to assess risk and make investment decisions, as smaller companies may offer higher growth potential but come with increased volatility. Exchange-traded funds, ETFs, and mutual funds are also key concepts worth understanding. Both are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. While mutual funds are actively managed and traded once daily at the net asset value, NAV, ETFs are passively managed and traded on stock exchanges throughout the day, allowing for more flexibility. Knowing the differences between these investment options can help you choose the right vehicle for your financial goals. Lastly, terms such as bull market and bear market describe market conditions that affect investor sentiment and trading behavior. A bull market indicates a period of rising prices and optimism, while a bear market signifies falling prices and pessimism. Recognizing these market trends can aid in timing your investments and understanding broader economic cycles. By familiarizing yourself with these key stock market terms, you can enhance your confidence and competence in your investing journey, ultimately leading to smarter financial decisions and stronger wealth-building strategies. Buying and selling stocks. Buying and selling stocks is a fundamental aspect of investing that can seem daunting to beginners. Understanding the mechanics of stock transactions is crucial for anyone looking to build wealth through the stock market. At its core, buying a stock means purchasing a piece of ownership in a company, while selling involves relinquishing that ownership, usually with the intention of realizing a profit. The first step in this process is to open a brokerage account, which will serve as the platform for executing trades. Choosing the right broker, one that aligns with your investment goals, offers educational resources, and has reasonable fees, is essential for a smooth investing experience. When you decide to buy stocks, you can do so through various order types. The most common are market orders and limit orders. A market order buys a stock at its current market price, ensuring the transaction is executed quickly but without control over the exact price you pay. On the other hand, a limit order allows you to set a specific price at which you are willing to buy. This method can be advantageous if you believe a stock is overvalued at its current price but want to capitalize on potential future dips. Understanding these order types will empower you to make more informed decisions when entering the market. Selling stocks also involves strategic considerations. Investors may choose to sell for various reasons: to lock in profits, cut losses, or reallocate funds into more promising investments. Timing is crucial, and it's important to have a clear strategy in place. For instance, setting price targets or stop-loss orders can help manage risk and maximize returns. Additionally, being aware of market trends, economic indicators, and company performance can provide valuable insights that inform your selling decisions. Emotional discipline is essential to avoid impulsive actions driven by market fluctuations. It's also important to develop a long-term perspective when buying and selling stocks. Short-term trading can be tempting, especially with the allure of quick profits, but it often leads to increased risk and potential losses. A focus on long-term investment strategies, such as dollar-cost averaging or value investing, can mitigate risks and enhance overall returns. By consistently investing over time, you can benefit from compounding and market growth, rather than being swayed by daily price changes. Finally, education and continuous learning play vital roles in successful stock trading. The stock market is influenced by various factors, including economic data, geopolitical events, and company news. Staying informed through reputable financial news sources, attending workshops, or engaging with investment communities can enhance your understanding and confidence in making buy and sell decisions. Remember, investing in stocks is not merely about transactions. It's about building a solid foundation for your financial future through informed and deliberate actions. Chapter 4: Understanding mutual funds and ETFs. What are mutual funds? Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. This collective investment strategy allows individual investors to access a broader range of assets than they might be able to afford on their own. By combining resources, mutual funds can buy larger quantities of securities, which can lead to better pricing and reduced transaction costs. This democratization of investing enables beginners to participate in the financial markets with relatively small amounts of capital. One of the primary benefits of mutual funds is diversification. By investing in a mutual fund, you are not putting all your eggs in one basket. Instead, your investment is spread across various assets, which can help reduce risk. For example, if one security in the fund performs poorly, the impact on the overall portfolio may be minimal, as other securities may be performing well. This built-in risk management feature is particularly appealing for new investors who may not yet have the expertise to diversify their own portfolios effectively. Mutual funds are managed by professional portfolio managers who make investment decisions on behalf of the fund's investors. These professionals conduct thorough research and analysis to determine which securities to buy or sell based on the fund's investment objectives. This management aspect is advantageous for beginners who may lack the time or knowledge to manage their investments actively. However, it is essential to note that mutual funds typically charge management fees, which can vary significantly between funds and may impact your overall returns. Investors can choose from various types of mutual funds, including equity funds, bond funds, and balanced funds, each designed to meet different investment goals and risk tolerances. Equity funds primarily invest in stocks and are suitable for those seeking long-term growth, while bond funds focus on fixed income securities and may appeal to conservative investors looking for stability. Balanced funds combine both stocks and bonds, providing a middle ground for those who want a balanced approach to risk and return. Understanding these options is crucial for selecting the right fund that aligns with your financial goals. When considering mutual funds, it is essential to review factors such as historical performance, fees, and the fund's investment strategy. While past performance is not indicative of future results, it can provide insight into how the fund has reacted in different market conditions. Additionally, understanding the fee structure, including management fees and expense ratios, is vital, as high fees can erode your investment returns over time. By educating yourself about mutual funds and their characteristics, you can make informed decisions that will help you build wealth over the long term. Exploring exchange-traded funds, ETFs. Exchange-traded funds, ETFs, have emerged as a popular investment vehicle, particularly among beginners looking to enter the stock market. An ETF is a type of fund that holds a collection of assets, such as stocks, bonds, or commodities, and trades on an exchange like a stock. This unique structure allows investors to buy and sell shares throughout the trading day at market prices, providing flexibility and liquidity that traditional mutual funds do not offer. Understanding how ETFs work is essential for new investors aiming to build a diversified portfolio with lower costs and reduced risk. One of the primary advantages of ETFs is their inherent diversification. By investing in an ETF, you gain exposure to a broad range of securities within a single investment. For instance, an ETF that tracks the S&P 500 index will include shares of all 500 companies in that index, allowing you to spread your risk across various sectors and industries. This is particularly beneficial for beginners who might not have the time, knowledge, or resources to research and invest in individual stocks. Diversification is a key principle in risk management, as it can help mitigate the impact of poor performance by any single asset in your portfolio. Cost-effectiveness is another significant benefit of ETFs. Most ETFs have lower expense ratios compared to traditional mutual funds, which often come with higher management fees. This cost advantage is largely due to the passive management style of many ETFs, which aim to replicate the performance of a specific index rather than actively selecting securities. For new investors, keeping costs low is crucial for maximizing returns over time, as high fees can erode profits and hinder wealth accumulation. Additionally, many brokers now offer commission-free trading for ETFs, further reducing the cost of entry for beginner investors. Investors should also be aware of the different types of ETFs available in the market, as they cater to various investment strategies and goals. Equity ETFs focus on stocks, while bond ETFs concentrate on fixed income securities. There are also sector ETFs that target specific industries, international ETFs that provide global exposure, and thematic ETFs that invest based on particular trends or themes. Understanding these options allows new investors to make informed decisions that align with their investment objectives and risk tolerance. Lastly, it is essential to consider the potential risks associated with investing in ETFs. While they offer diversification and lower costs, they are still subject to market fluctuations and can experience volatility like individual stocks. New investors should conduct thorough research on the underlying assets of the ETFs they are interested in and consider how these fit into their overall investment strategy. By balancing the benefits of ETFs with an awareness of their risks, beginners can effectively use these investment vehicles to build wealth over time and work towards their financial goals. Advantages and disadvantages of funds. Investing in funds, such as mutual funds and exchange-traded funds, ETFs, provides numerous advantages for beginners looking to build wealth. One significant benefit is diversification. Funds typically invest in a wide range of securities, which helps spread risk across different assets. This diversification can mitigate the impact of poor performance from any single investment, offering a buffer against market volatility. For new investors who may lack the experience to select individual stocks, funds present a straightforward way to gain exposure to various sectors and industries. Another advantage of funds is professional management. Most mutual funds and ETFs are managed by experienced financial professionals who conduct extensive research and analysis before making investment decisions. This management aspect can be particularly appealing to beginners who may not have the time or expertise to manage their portfolios actively. By investing in a fund, individuals can benefit from the knowledge and skills of these professionals, allowing them to invest more confidently as they focus on their long-term financial goals. However, investing in funds also comes with certain disadvantages that beginners should be aware of. One notable drawback is the associated fees. Many mutual funds charge management fees, administrative fees, or sales loads, which can eat into returns over time. Even low-cost index funds can have expense ratios that impact overall performance, especially if the investment horizon is short. Therefore, it is essential for investors to carefully analyze the fee structures of any fund they consider, as higher fees can significantly reduce net gains. Additionally, while funds offer diversification, they may not provide the same level of control as investing in individual stocks or assets. Investors in mutual funds or ETFs must accept the fund manager's decisions regarding investment strategy and asset allocation. This lack of control can be frustrating for some, particularly those who prefer to tailor their investments to their specific preferences or market outlook. Furthermore, funds can sometimes lead to a false sense of security. Just because a portfolio is diversified does not guarantee protection against losses. Lastly, the performance of funds can vary significantly based on market conditions and the strategies employed by the fund manager. While some funds may perform exceptionally well, others may lag behind their benchmarks or the overall market. Beginners should be cautious and conduct thorough research before investing in any fund, understanding both the potential rewards and the risks involved. By weighing the advantages and disadvantages, new investors can make informed decisions that align with their financial objectives and risk tolerance, ultimately enhancing their journey toward wealth building. Chapter 5. Cryptocurrency Investment Fundamentals. Introduction to cryptocurrency. Cryptocurrency represents a revolutionary shift in the way we think about money and transactions. At its core, cryptocurrency is a digital or virtual form of currency that uses cryptography for security, making it difficult to counterfeit or double spend. Unlike traditional currencies issued by governments, cryptocurrencies operate on decentralized networks based on blockchain technology. This technology not only enhances security but also ensures transparency in transactions, as every transaction is recorded on a public ledger accessible to anyone. Understanding these fundamentals is essential for anyone looking to navigate the evolving landscape of digital finance. One of the most significant aspects of cryptocurrency is its decentralized nature, which removes the need for intermediaries such as banks or financial institutions. This decentralization empowers individuals by giving them more control over their finances and reducing transaction fees associated with traditional banking systems. However, it also introduces new challenges, such as volatility and security concerns. For beginner investors, grasping these concepts is crucial, as they will influence investment decisions and risk management strategies in the cryptocurrency market. The most well-known cryptocurrency, Bitcoin, was introduced in 2009, but since then, thousands of alternative cryptocurrencies, often referred to as altcoins, have emerged. Each of these cryptocurrencies has unique features, use cases, and underlying technologies. For instance, Ethereum, the second-largest cryptocurrency by market capitalization, offers a platform for decentralized applications and smart contracts. Understanding the differences between various cryptocurrencies can provide investors with a broader perspective on potential opportunities and risks in the market. Investing in cryptocurrency can be enticing due to the potential for high returns, but it is essential to approach it with caution. The cryptocurrency market is known for its price volatility, which can lead to significant gains or losses in a short period. Therefore, it is crucial for beginner investors to conduct thorough research and develop a solid investment strategy that includes risk management techniques. This strategy should encompass diversification, understanding market trends, and setting clear investment goals to navigate the unpredictable nature of cryptocurrency investments. As you embark on your cryptocurrency investment journey, it is vital to stay informed about ongoing developments in the sector. Regulatory changes, technological advancements, and market sentiment can all influence cryptocurrency prices and investment opportunities. Engaging with educational resources, following industry news, and connecting with experienced investors can enhance your understanding and help you make informed decisions. By integrating cryptocurrency into a broader investment strategy, you can potentially capitalize on this innovative financial frontier while building a sustainable wealth portfolio. How to invest in cryptocurrencies. Investing in cryptocurrencies can be an exciting yet daunting venture for beginners. The first step is to understand what cryptocurrencies are and how they function. Unlike traditional currencies, cryptocurrencies operate on decentralized networks based on blockchain technology. This technology ensures transparency and security in transactions, making it essential for investors to grasp its fundamentals. Familiarizing yourself with key concepts such as wallets, exchanges, and the various types of cryptocurrencies will provide a solid foundation for your investment journey. Once you have a basic understanding of cryptocurrencies, the next step is to choose a reliable cryptocurrency exchange. Exchanges are platforms where you can buy, sell, and trade cryptocurrencies. It is crucial to select an exchange that prioritizes security, offers a user-friendly interface, and provides a variety of cryptocurrencies to choose from. Researching the exchange's reputation, fee structure, and customer support options can help you make an informed decision. Popular exchanges like Coinbase, Binance, and Kraken are often recommended for beginners due to their robust security measures and educational resources. After selecting an exchange, the process of setting up a digital wallet becomes vital. A wallet is a secure digital space where you can store your cryptocurrencies. There are different types of wallets, including hot wallets, connected to the internet, and cold wallets, offline storage. For beginners, starting with a hot wallet can be convenient for trading, but as your investment grows, transitioning to a cold wallet for long-term storage will enhance security. Understanding how to safely manage your private keys and back up your wallet is essential to protect your investment. When it comes to investing strategies, it is advisable to start small and gradually increase your investment as you gain confidence and experience. Dollar cost averaging, where you invest a fixed amount regularly regardless of market conditions, can be an effective strategy for mitigating risks. This approach allows you to build your portfolio over time without the stress of trying to time the market. Additionally, diversifying your investments across various cryptocurrencies can help spread risk, as different assets can perform differently under various market conditions. Finally, managing risks associated with cryptocurrency investments is paramount. The cryptocurrency market is known for its volatility, which can lead to significant price fluctuations. Setting clear investment goals, determining your risk tolerance, and maintaining a diversified portfolio can help you navigate this unpredictable landscape. It is also essential to stay informed about market trends, regulatory changes, and technological advancements that may impact your investments. By adopting a disciplined approach and continuously educating yourself, you can enhance your chances of achieving long-term success in the world of cryptocurrency investing. Risks and rewards of crypto investing. The world of cryptocurrency has garnered immense popularity in recent years, attracting both novice and seasoned investors alike. However, with the potential for significant gains comes an array of risks that must be understood and managed. For beginners, grasping the dichotomy of risks and rewards in crypto investing is essential to making informed decisions. Cryptocurrencies, such as Bitcoin and Ethereum, have offered remarkable returns to early adopters, but the volatility of these digital assets can lead to substantial losses for those who are unprepared. One of the primary rewards of investing in cryptocurrency is the opportunity for high returns. Unlike traditional investments, cryptocurrencies have shown the ability to surge in value within a short period. For instance, Bitcoin's meteoric rise from a few cents to tens of thousands of dollars has created a wealth of opportunities for investors. This potential for rapid appreciation attracts many who are seeking to diversify their portfolios and capitalize on the innovative nature of blockchain technology. Moreover, cryptocurrencies operate independently of traditional financial institutions, which can appeal to those interested in alternative forms of investment. However, the allure of high returns is tempered by the inherent risks associated with cryptocurrency markets. Price volatility is a defining characteristic of these digital assets, often leading to significant fluctuations in value over short time frames. This unpredictability can be daunting for new investors, as it may result in emotional decision-making driven by fear or greed. Additionally, the lack of regulation in the cryptocurrency space raises concerns about market manipulation and fraud, making it vital for beginners to conduct thorough research before investing. Another critical aspect of crypto investing is the technological and security risks involved. As digital assets, cryptocurrencies are susceptible to hacking and theft, which can lead to the loss of funds. The decentralized nature of blockchain technology offers some protection, but it also places the responsibility of security largely on the investor. Beginners should familiarize themselves with best practices for safeguarding their investments, such as using secure wallets and enabling two-factor authentication. Understanding these risks can empower investors to take proactive measures to protect their assets. In conclusion, the journey into cryptocurrency investing is filled with both potential rewards and significant risks. For beginners, it is crucial to approach this market with a balanced perspective, recognizing the possibility of substantial gains while remaining vigilant about the pitfalls. By educating themselves on the fundamentals of crypto investing, embracing sound risk management strategies, and maintaining a disciplined approach, new investors can navigate this volatile landscape more effectively. Ultimately, informed decisions rooted in knowledge and awareness can lead to a rewarding investment experience in the world of cryptocurrencies. Chapter 6: Retirement Accounts and Long-Term Investing. Types of retirement accounts. Retirement accounts play a crucial role in long-term financial planning, providing individuals with the opportunity to save and invest for their future. Understanding the various types of retirement accounts is essential for beginners seeking to maximize their savings and investment potential. The most common types of retirement accounts include traditional IRAs, Roth IRAs, 401k plans, and other employer-sponsored retirement plans. Each of these accounts offers unique benefits and potential drawbacks, making it important for investors to assess their own financial situations and goals when choosing the right account. Traditional IRAs, individual retirement accounts, allow individuals to contribute pre-tax income, which can lead to immediate tax deductions. This means that the money invested in a traditional IRA can grow tax-deferred until withdrawal during retirement. The withdrawals made during retirement are taxed as ordinary income, which can be advantageous for individuals who expect to be in a lower tax bracket upon retirement. However, there are specific contribution limits and rules about withdrawals before the age of 59 and a half, making it essential for investors to familiarize themselves with these regulations. Roth IRAs, on the other hand, offer a different tax structure. Contributions to a Roth IRA are made with after-tax dollars, meaning that investors do not receive an immediate tax deduction. However, the significant advantage of a Roth IRA lies in its tax-free growth and tax-free withdrawals during retirement, provided certain conditions are met. This type of account is particularly beneficial for younger investors who may anticipate being in a higher tax bracket in the future, as it allows them to lock in their current tax rate while enjoying tax-free income later in life. Employer-sponsored retirement plans, such as 401k and 403b plans, are popular options for many employees. These plans allow workers to contribute a portion of their salary before taxes are taken out, similar to traditional IRAs. Many employers also offer matching contributions, which can significantly enhance the growth of an employee's retirement savings. It is crucial for employees to take full advantage of any available employer match, as this is essentially free money that can accelerate their savings journey. Additionally, 401k plans often provide a variety of investment options, including mutual funds and ETFs, enabling participants to diversify their portfolios. Finally, other types of retirement accounts, such as SEP IRAs and simple IRAs, cater specifically to self-employed individuals and small business owners. SEP IRAs allow for larger contributions compared to traditional IRAs, making them an attractive option for those with fluctuating income. Simple IRAs provide a straightforward way for small businesses to offer retirement benefits to their employees, with lower administrative costs than larger plans. Understanding these diverse retirement account options empowers individuals to make informed decisions about their financial futures, ensuring they are well prepared for retirement. Benefits of long-term investing. Long-term investing offers a multitude of benefits that can significantly enhance an individual's financial well-being. One of the most compelling advantages is the potential for compound growth. When investments are held over an extended period, the returns generated can be reinvested, leading to exponential growth. This phenomenon, often referred to as the snowball effect, allows even modest initial investments to grow substantially over time. For beginners, understanding the power of compounding can motivate them to adopt a long-term perspective rather than seeking quick profits. Another key benefit of long-term investing is the reduction of market volatility's impact on an investment portfolio. The stock market can be unpredictable in the short term, with prices fluctuating due to a variety of factors, including economic indicators and geopolitical events. However, by maintaining an investment over several years, investors can ride out these short-term fluctuations. Historical data shows that markets tend to recover from downturns, and those who stay invested through volatility often see their investments rebound and grow, making long-term strategies particularly appealing for new investors. Tax advantages also play a significant role in the benefits of long-term investing. Many countries offer preferential tax treatment for long-term capital gains, meaning that investments held for over a year are taxed at a lower rate than those sold within a year. This not only allows investors to keep more of their gains, but also incentivizes them to hold onto their investments longer. For beginners, understanding these tax implications can be crucial in building a robust investment strategy that maximizes returns while minimizing tax liabilities. In addition to financial benefits, long-term investing fosters discipline and strategic thinking. It encourages investors to create a well-thought-out plan and stick to it, rather than making impulsive decisions based on short-term market trends. This disciplined approach can help mitigate the effects of emotional decision-making, which is a common pitfall for novice investors. By focusing on long-term goals, individuals can develop better investment habits and enhance their overall financial literacy. Lastly, long-term investing can contribute to a more profound sense of financial security and peace of mind. Knowing that investments are being nurtured over time allows individuals to focus on other aspects of their lives without the constant worry of market changes. This long-term perspective not only helps in building wealth, but also in planning for significant life events such as buying a home, funding education, or preparing for retirement. Overall, embracing a long-term investment strategy can lead to greater financial stability and a more fulfilling approach to wealth building. Strategies for retirement planning. Retirement planning is a crucial aspect of financial well-being that requires thoughtful strategies to ensure that individuals can maintain their desired lifestyle after leaving the workforce. One of the foundational strategies for effective retirement planning is to start early. The power of compound interest can significantly enhance retirement savings, making it essential for individuals to begin contributing to retirement accounts as soon as possible. Whether through employer-sponsored plans such as 401k or individual retirement accounts, IRAs, Early contributions can lead to substantial growth over time, allowing investments to generate earnings that can be reinvested. Another key strategy is to take advantage of employer matching contributions. Many employers offer matching contributions for retirement accounts, which represent free money that can substantially boost an employee's retirement savings. It is vital for individuals to understand the terms of their employer's matching program and to contribute enough to receive the full match. This not only maximizes the benefits of retirement accounts, but also reinforces the habit of saving for the future. Diversification is also an essential strategy in retirement planning. By spreading investments across various asset classes, such as stocks, bonds, mutual funds, and even alternative investments like real estate or cryptocurrencies, individuals can manage risk more effectively. A well-diversified portfolio can help protect against market volatility while ensuring that retirement savings grow over time. It's important to periodically review and adjust the asset allocation based on changing market conditions, personal risk tolerance, and retirement goals. In addition to traditional investment strategies, individuals should consider incorporating tax-efficient investing into their retirement planning. Understanding the tax implications of different investment vehicles can lead to significant savings over the long term. For instance, holding assets in tax-advantaged accounts like Roth IRAs allows for tax-free growth and withdrawals in retirement. Furthermore, being mindful of capital gains taxes when selling investments can enhance overall returns and contribute to a more secure retirement. Finally, creating a detailed retirement budget is crucial for effective planning. Individuals should estimate their future expenses, considering factors such as healthcare, housing, and lifestyle choices. This budget will serve as a roadmap, guiding investment decisions and savings goals. Regularly revisiting and adjusting this budget in response to life changes or shifts in financial markets can ensure that individuals remain on track to meet their retirement objectives. By integrating these strategies into their financial planning, individuals can lay a strong foundation for a secure and fulfilling retirement. Chapter 7: Budgeting and Saving for Investment. Creating a personal budget. Creating a personal budget is a fundamental step in establishing a solid financial foundation for investment. A well-structured budget enables you to track your income and expenses, ultimately allowing you to allocate funds towards your investment goals. It serves as a roadmap for your financial journey, helping you identify areas where you can save and invest more effectively. Understanding the components of a budget is essential for anyone looking to build wealth, particularly for beginners in investing. The first step in creating a personal budget is to assess your income. This includes all sources of revenue, such as your salary, freelance work, dividends, and any passive income streams. Accurate income assessment is crucial as it sets the baseline for your budget. Once you have a clear picture of your total income, you should categorize your expenses into fixed and variable costs. Fixed expenses include rent or mortgage payments, insurance, and utilities, while variable expenses encompass groceries, entertainment, and discretionary spending. This categorization will help you identify necessary versus optional costs, allowing you to make informed decisions about where to cut back. Next, it is essential to set financial goals that align with your investment ambitions. These goals should be specific, measurable, achievable, relevant, and time-bound. SMART. For example, if your aim is to invest in a diversified portfolio of stocks and mutual funds, you need to determine how much money you can allocate towards that goal each month. By incorporating these investment goals into your budget, you create a dedicated space for your future wealth-building activities. This practice not only fosters discipline but also encourages you to prioritize saving and investing over unnecessary expenditures. Once you have established your budget and set your financial goals, it's vital to monitor and adjust your budget regularly. Life circumstances and financial situations can change, affecting your income and expenses. By reviewing your budget monthly, you can track your spending habits, identify any deviations, and make necessary adjustments. This ongoing assessment will also help you stay committed to your investment strategy and ensure that you are consistently working towards your financial goals. Utilizing budgeting tools or apps can streamline this process, providing insights into your spending patterns. Finally, creating a personal budget involves cultivating a mindset focused on long-term financial health. Embrace the discipline of budgeting as a means to empower your investment journey. It is important to recognize that budgeting is not merely a constraint but a tool that enables you to take control of your financial future. By prioritizing savings and investments within your budget, you are laying the groundwork for wealth accumulation. A strong budgeting habit not only prepares you for future investments but also enhances your understanding of financial management, ultimately supporting your journey towards financial independence. Importance of saving for investments. Saving for investments is a crucial step in the journey to financial independence and wealth building. The act of saving creates a foundation upon which investments can be made, allowing individuals to capitalize on opportunities in various financial markets. Whether one is considering stocks, mutual funds, or even cryptocurrencies, having a dedicated pool of savings enables investors to act decisively when opportunities arise. This readiness can enhance the potential for higher returns and mitigate the risks associated with timing the market. Establishing a saving habit is essential for beginners who may feel overwhelmed by the complexities of investing. By prioritizing savings, individuals can develop a disciplined approach to their finances. Regularly setting aside a portion of income not only fosters a sense of financial security, but also prepares one for unexpected market fluctuations. The discipline gained from saving can translate into more informed and strategic investment decisions, steering clear of impulsive moves driven by market emotions. Moreover, saving for investments allows individuals to take advantage of compound interest. The earlier one starts saving, the more time their money has to grow. This exponential growth is particularly beneficial in long-term investments, such as retirement accounts. By consistently contributing to a savings plan, investors can harness the power of compounding, which can significantly increase their wealth over time. Understanding this principle is vital for beginners who are just starting to navigate the investment landscape. In addition to fostering growth, saving for investments provides a safety net that can enhance risk management. Beginners often face the challenge of balancing their investment portfolio with the inherent risks associated with different asset classes. Having a reserve of savings can allow investors to maintain their positions during market downturns rather than panic selling at a loss. This strategic approach can help preserve capital and enable investors to take calculated risks that align with their financial goals. Finally, the psychological aspect of saving for investments cannot be overlooked. Establishing a saving routine can instill confidence and reduce anxiety related to financial decisions. When individuals know they have funds set aside for investment, they are more likely to approach opportunities with a clear mind and a well-thought-out strategy. This mindset is essential for success in the often volatile world of investing, where emotional reactions can lead to misguided choices. By prioritizing savings, investors not only build their wealth, but also cultivate the mindset necessary for long-term success in the financial markets. Strategies for effective saving. Effective saving is a foundational strategy for anyone looking to build wealth and invest wisely. It begins with establishing clear financial goals, which serve as motivation and direction for your saving efforts. Consider what you want to achieve in both the short and long term. This might include saving for an emergency fund, a down payment on a home, or retirement. By defining specific, measurable goals, you can create a more focused savings plan. This clarity not only helps you allocate your resources more effectively, but also enables you to track your progress toward achieving your financial aspirations. Creating a budget is a crucial step in the saving process. A budget allows you to visualize your income and expenses, helping you identify areas where you can cut back. Start by listing your income sources and all your monthly expenses. Categorize your spending into fixed expenses, such as rent and utilities, and variable expenses like entertainment and dining out. Once you have a clear picture of your financial landscape, you can determine how much you can realistically save each month. This disciplined approach ensures that you are not only saving but also living within your means, which is essential for long-term financial health. Automating your savings is another effective strategy. By setting up automatic transfers from your checking account to a savings account or investment account, you prioritize saving without having to think about it actively. This technique not only simplifies the process, but also leverages the concept of paying yourself first. When saving becomes automatic, you reduce the temptation to spend that money on non-essential items. Over time, even small, consistent contributions can add up significantly, especially when compounded through investments. Additionally, consider utilizing high-yield savings accounts or other savings vehicles that offer better interest rates than traditional accounts. These options can help your savings grow more efficiently. Beyond traditional savings, explore investment accounts like a Roth IRA or a brokerage account for long-term growth. Understanding the different types of accounts available allows you to choose the ones that align best with your financial goals and timelines. Each option comes with its own set of benefits and risks, so researching and understanding these can greatly enhance your overall strategy. Finally, maintaining a mindset focused on the long term is vital for effective saving. It can be tempting to dip into your savings for immediate gratification, but staying committed to your goals will pay off in the future. Review your goals periodically and adjust your saving strategies as necessary, especially in response to changes in income or expenses. Incorporating behavioral finance principles, such as recognizing biases that may lead to impulsive spending, can further strengthen your saving habits. By cultivating discipline and patience, you can create a robust financial foundation that supports your investment journey and helps you achieve long-term wealth. Chapter 8: Risk Management in Beginner Investing. Understanding investment risks. Investment risks are an inherent part of the financial landscape, and understanding them is crucial for anyone looking to build wealth through investing. At its core, investment risk refers to the possibility of losing some or all of the original investment. This risk can arise from various factors, including market volatility, economic changes, and individual asset performance. For beginners, recognizing the different types of risks is the first step toward making informed investment decisions and developing a robust strategy that aligns with personal financial goals. There are several categories of investment risk that every investor should be familiar with. Market risk, also known as systematic risk, affects all investments in the market and is largely driven by external factors such as economic trends, geopolitical events, and changes in interest rates. On the other hand, specific or unsystematic risk pertains to individual assets or sectors and can be mitigated through diversification. Understanding these categories helps investors assess how different investments may react to various market conditions, allowing for more strategic asset allocation. Another critical aspect of investment risk is the concept of liquidity risk, which refers to the difficulty of selling an asset without causing a significant drop in its price. This is particularly relevant for assets like real estate or certain types of mutual funds that may not have a readily available market. Beginners should consider their investment horizon and the need for cash when selecting investments, as higher liquidity typically corresponds to lower potential returns. Balancing liquidity needs with the desire for higher returns is essential to a well-rounded investment strategy. Behavioral finance also plays a significant role in how investors perceive and manage risk. Cognitive biases can lead to irrational decision-making, causing investors to overreact to market fluctuations or ignore fundamental indicators of risk. For instance, the tendency to hold onto losing investments in hopes of a turnaround can be detrimental to long-term wealth building. Becoming aware of these psychological factors can help new investors maintain discipline and adhere to their investment strategies, even in the face of market volatility. Finally, risk management is not just about avoiding potential losses. It is about understanding and embracing risk as a component of investment growth. Beginners should develop a clear risk tolerance, which reflects their financial situation, investment objectives, and time horizon. By aligning their investment choices with their risk tolerance, individuals can pursue opportunities that offer the potential for returns while minimizing their exposure to unacceptable levels of risk. This thoughtful approach to risk management is a vital skill for anyone looking to invest wisely and achieve long-term financial success. Diversification strategies. Diversification strategies are essential for investors seeking to build a robust portfolio while managing risk. At its core, diversification involves spreading investments across various asset classes, sectors, and geographic regions to reduce the impact of any single investment's poor performance on the overall portfolio. By not putting all your eggs in one basket, you can potentially enhance your returns while mitigating losses, making diversification a fundamental principle of sound investing. One common approach to diversification is asset allocation, which involves determining the right mix of stocks, bonds, and other securities based on your risk tolerance and investment goals. For instance, younger investors may lean towards a higher proportion of stocks, given their longer time horizon and ability to weather market fluctuations. Conversely, those nearing retirement might prioritize bonds and stable income-generating assets to preserve capital. By balancing these asset classes, investors can achieve a level of risk that aligns with their financial aspirations. Another effective diversification strategy is sector allocation. Different sectors of the economy perform differently under various market conditions. For example, during economic expansions, technology and consumer discretionary sectors often thrive, while defensive sectors like utilities and healthcare may perform better during downturns. By investing in a mix of sectors, investors can safeguard their portfolios against sector-specific risks and capitalize on growth opportunities across various industries. Geographic diversification is also crucial, especially in today's global economy. Investing in international markets can provide exposure to growth opportunities outside one's home country. Global events, such as political changes or economic crises, can affect regional markets differently. By holding investments in multiple countries or regions, investors can reduce the risk associated with domestic market fluctuations and benefit from global economic growth. Finally, diversification can extend to investment vehicles such as mutual funds and exchange-traded funds, ETFs, which inherently provide diversified exposure to various securities. These funds pool money from multiple investors to purchase a broad range of assets, allowing individual investors to gain diversification without needing to buy each security directly. This is particularly advantageous for beginner investors who may lack the time or expertise to manage a diversified portfolio on their own. By embracing diversification strategies, investors can create a more resilient investment portfolio, poised for long-term success amidst market volatility. Setting risk tolerance levels. Setting risk tolerance levels is a crucial step for any beginner investor seeking to build wealth. Risk tolerance refers to the degree of variability in investment returns that an individual is willing to withstand in their investment portfolio. Understanding your own risk tolerance is essential because it influences your investment choices, the types of assets you select, and ultimately your investment strategy. By assessing your risk tolerance, you can align your investment decisions with your financial goals and psychological comfort, enabling a more confident approach to investing. To effectively determine your risk tolerance, it is essential to consider several factors, including your financial situation, investment goals, time horizon, and personal comfort with uncertainty. Begin by evaluating your current financial status, including your income, expenses, savings, and any existing debts. A stronger financial foundation often allows for a higher risk tolerance since you may have the means to recover from potential losses. Additionally, consider your investment objectives. For example, if you are investing for long-term growth, you might be more inclined to accept higher risks compared to someone investing for short-term gains or capital preservation. Another critical aspect in assessing risk tolerance is your time horizon. The longer your investment period, the more time you have to recover from market fluctuations. Younger investors with a longer time frame until retirement or significant financial milestones can typically afford to take on more risk, as they have time to weather market downturns. Conversely, those nearing retirement or with short-term goals may prioritize capital preservation and lean toward lower-risk investments. Understanding the relationship between time horizon and risk is vital for crafting a suitable investment strategy. It is also important to reflect on your emotional responses to market volatility. Behavioral finance suggests that investors often react irrationally to market changes, driven by fear or greed. To set realistic risk tolerance levels, consider conducting a self-assessment or utilizing risk tolerance questionnaires available from financial institutions. These tools can provide insights into your psychological predispositions regarding risk and help identify whether you are more risk-averse or risk-seeking. Recognizing your emotional tendencies can inform how you manage your investments and cope with market fluctuations. Lastly, it is essential to revisit and adjust your risk tolerance levels as your financial situation and life circumstances evolve. Major life events such as marriage, the birth of a child, or career changes can significantly impact your financial goals and risk appetite. Regularly reviewing your investment strategy and risk tolerance ensures that your portfolio remains aligned with your current objectives and comfort levels. By actively managing your risk tolerance, you position yourself to navigate the complexities of investing with greater confidence and success, ultimately paving the way toward building lasting wealth. Chapter 9: Behavioral Finance and Investment Psychology. The psychology of investing. The psychology of investing plays a crucial role in how individuals approach their financial decisions. Understanding the mental and emotional factors that influence investment behavior can significantly impact investment success. Investors often face various biases and emotions, such as fear, greed, and overconfidence, which can lead to irrational decision-making. Recognizing these psychological influences is essential for beginners who wish to build a solid foundation for long-term wealth accumulation. One common psychological bias is loss aversion, where individuals are more sensitive to losses than equivalent gains. This phenomenon can lead to holding on to losing investments for too long or selling winning investments prematurely. By understanding loss aversion, new investors can cultivate a more balanced perspective on their portfolios. Strategies such as setting predetermined stop-loss and take-profit levels can help mitigate the emotional toll associated with these biases, allowing for more rational decision-making. Another significant factor in investment psychology is the impact of social influences and herd behavior. New investors often look to their peers, social media, and financial news for guidance, which can lead to impulsive investment choices driven by the fear of missing out, FOMO. This herd mentality can result in poor timing and increased volatility in personal investment portfolios. By fostering independent research habits and developing a personalized investment strategy, beginners can counteract the pressure to conform to popular trends and make decisions based on sound analysis rather than external influences. Emotional discipline is vital for successful investing. The markets can be unpredictable, and prices fluctuate based on various factors, including economic indicators and global events. Beginners must learn to manage their emotions and remain committed to their long-term investment strategies, even during market downturns. Developing a well-defined investment plan that includes clear goals and risk tolerance can help investors maintain focus and resilience in the face of market challenges. Finally, understanding the principles of behavioral finance can empower beginners to make more informed decisions. This field studies how psychological factors affect financial behaviors, providing valuable insights into why investors may act against their best interests. By recognizing cognitive biases such as confirmation bias or anchoring, new investors can train themselves to approach their investment choices with a more analytical mindset. This awareness can lead to more disciplined and informed investment strategies, ultimately contributing to long-term financial success. Common cognitive biases. Cognitive biases are systematic patterns of deviation from norm or rationality in judgment, and they can significantly influence investment decisions. Understanding these biases is crucial for beginners in investing, as they can lead to poor financial choices that hinder wealth-building efforts. By identifying and acknowledging these biases, new investors can better navigate the complexities of the stock market, mutual funds, ETFs, and other investment vehicles. This chapter will explore some of the most common cognitive biases that can affect financial decision-making and provide tips on how to mitigate their impact. One prevalent bias is confirmation bias, which occurs when individuals favor information that confirms their existing beliefs or hypotheses. In the context of investing, this may lead a beginner to focus only on positive news about a stock they own, while ignoring negative reports or alternative viewpoints. This selective perception can result in a skewed understanding of an investment's performance and potential risks. To counteract confirmation bias, new investors should strive to seek out diverse perspectives, critically evaluate all available information, and remain open to changing their views based on new evidence. Another significant cognitive bias is loss aversion, which refers to the tendency to prefer avoiding losses over acquiring equivalent gains. Research shows that losses can feel psychologically more impactful than gains of the same size. For new investors, this bias may lead to holding on to losing investments too long in the hope of recovering losses, or conversely, selling winning investments prematurely out of fear of future losses. To mitigate loss aversion, investors should develop a clear investment strategy and adhere to it, focusing on long-term goals rather than short-term fluctuations in value. The bandwagon effect is also common among novice investors, characterized by the tendency to follow the crowd or adopt the popular opinion. This bias can lead individuals to invest in trending stocks or assets without conducting thorough research, simply because others are doing so. While it is important to stay informed about market trends, relying solely on popular opinion can result in poor investment choices. Beginners should cultivate an independent investment strategy based on their financial goals, risk tolerance, and thorough analysis rather than merely following the herd. Finally, overconfidence bias can be detrimental to new investors, as it leads them to overestimate their knowledge or predictive abilities. This can manifest in excessive trading, underestimating risks, or ignoring expert advice. Overconfidence can result in significant financial losses, especially when investing in volatile markets like cryptocurrencies. To combat overconfidence, beginners should engage in continuous learning, seek guidance from financial professionals, and regularly assess their investment performance and decision-making processes. By remaining humble and aware of their limitations, new investors can make more informed and rational investment choices. Strategies to improve investment mindset. To cultivate a productive investment mindset, one must first embrace the importance of financial education. Understanding the fundamentals of investing, including concepts related to stocks, bonds, mutual funds, and cryptocurrencies, is crucial for beginners. This knowledge empowers individuals to make informed decisions rather than relying on emotions or hearsay. Engaging with educational resources such as books, online courses, and webinars can significantly enhance one's investment literacy. By dedicating time to learn about different investment vehicles, individuals can better assess their options and align them with their financial goals. Setting clear, achievable investment goals is another essential strategy for improving one's investment mindset. Goals should be specific, measurable, attainable, relevant, and time-bound, SMART. For example, a beginner might aim to save a certain amount for retirement or to invest a specific percentage of their monthly income. By having clear objectives, investors can maintain focus and motivation, which helps to mitigate the emotional roller coaster often associated with market fluctuations. Regularly revisiting and adjusting these goals as circumstances change further solidifies a proactive investment approach. Developing a disciplined investment routine is vital to fostering a strong investment mindset. This involves creating a systematic plan for making investments, whether through dollar-cost averaging, or regular contributions to retirement accounts. Establishing a routine helps reduce impulsivity and emotional decision-making, which are common pitfalls for novice investors. Additionally, automating investments can simplify the process, ensuring that individuals consistently contribute to their investment accounts without needing to actively manage the timing of their contributions. Embracing a long-term perspective is critical in shaping a successful investment mindset. Short-term market volatility can often lead to panic selling or hasty decisions that undermine long-term financial health. Investors should focus on their long-term objectives, understanding that market fluctuations are a natural part of the investment landscape. By adopting a buy-and-hold strategy and resisting the urge to react to daily market changes, individuals can cultivate resilience and patience, essential traits for successful investing. Lastly, understanding and managing risk is fundamental to improving one's investment mindset. New investors should familiarize themselves with their risk tolerance and how it influences their investment choices. Diversifying a portfolio across various asset classes, including stocks, bonds, mutual funds, and even cryptocurrencies, can help mitigate risk while maximizing potential returns. Moreover, recognizing the psychological aspects of risk, such as loss aversion and overconfidence, can aid investors in making more rational decisions. By acknowledging and addressing these behavioral tendencies, individuals can navigate the investment landscape with greater confidence and clarity. Chapter 10. Putting it all together. Developing your investment plan. Developing an investment plan is a crucial first step on the journey to financial independence and wealth building. A well-structured investment plan provides clarity on your financial goals, risk tolerance, and the strategies you will employ to achieve those goals. To begin, it is essential to define what you are investing for. Whether your aim is to build a retirement nest egg, save for a child's education, or accumulate wealth for personal enjoyment, having a clear objective will guide your decision-making process. Take the time to write down your goals, ensuring they are specific, measurable, achievable, relevant, and time-bound. Smart. Once you have established your investment objectives, the next step is to assess your risk tolerance. Risk tolerance refers to the degree of variability in investment returns that you are willing to withstand. Factors such as your age, income, investment horizon, and personal comfort with market fluctuations will influence your risk profile. Younger investors may opt for a more aggressive approach, investing in stocks or cryptocurrencies for potential high returns, while those nearing retirement might prefer more conservative investments like bonds or mutual funds. Understanding your risk tolerance helps in selecting the right mix of assets that aligns with your financial goals. Asset allocation is a key component of your investment plan. This strategy involves distributing your investments across various asset classes, such as stocks, bonds, mutual funds, ETFs, and perhaps cryptocurrencies. The idea is to create a diversified portfolio that balances risk and reward, minimizing the impact of volatility in any single investment. For instance, a balanced portfolio may include a combination of stocks for growth and bonds for stability. As market conditions change, revisiting and adjusting your asset allocation ensures that your investments remain aligned with your goals and risk tolerance. Budgeting and saving are fundamental aspects of developing your investment plan. Before you can invest, it is essential to establish a budget that allows you to allocate a portion of your income towards investments. Consider your monthly expenses and identify areas where you can cut back to increase your savings. An emergency fund is also important. It provides a financial cushion that prevents you from having to liquidate investments during market downturns. By consistently saving and investing a portion of your income, you harness the power of compound interest, which can significantly enhance your wealth over time. Finally, incorporating risk management strategies into your investment plan is vital for long-term success. Understanding the principles of behavioral finance can help you avoid common psychological pitfalls that affect investment decisions. For example, fear and greed can lead to impulsive actions, such as panic selling during market dips or overinvesting during bull markets. Establishing a clear investment strategy, setting stop-loss orders, and maintaining a disciplined approach can mitigate these risks. Regularly reviewing your investment plan, staying informed about market trends, and adapting your strategy as needed will empower you to navigate the complexities of investing with confidence. Monitoring and adjusting your portfolio. Monitoring your investment portfolio is a crucial aspect of successful investing, particularly for beginners. Regularly reviewing your holdings allows you to assess their performance, understand market trends, and make informed decisions about your financial future. Start by establishing a routine for monitoring your portfolio, whether it's weekly, monthly, or quarterly. This routine should include checking the performance of your investments against relevant benchmarks, analyzing market news that could impact your holdings, and assessing whether your investments are aligned with your financial goals and risk tolerance. As you monitor your portfolio, it's essential to differentiate between short-term fluctuations and long-term trends. The stock market can be volatile, and prices may rise and fall dramatically over short periods. However, a focus on long-term performance will provide a clearer picture of whether your investments are meeting your expectations. Look at broader trends, such as economic indicators and industry developments, rather than reacting impulsively to daily market changes. This approach will help you maintain a level-headed perspective and avoid making emotional decisions driven by fear or greed. Adjusting your portfolio is just as important as monitoring it. Over time, your investment goals, risk tolerance, and market conditions may change, necessitating adjustments to your asset allocation. For example, if you find that your risk tolerance has decreased due to market volatility, you might consider shifting a portion of your investments from stocks to more stable options like bonds or mutual funds. Conversely, if you are in a position to take on more risk for potentially higher returns, you might increase your allocation to growth stocks or cryptocurrencies. Regular adjustments ensure that your portfolio remains aligned with your financial objectives and personal circumstances. Additionally, diversification plays a vital role in both monitoring and adjusting your portfolio. A well-diversified portfolio can help mitigate risk by spreading investments across various asset classes, sectors, and geographic regions. As you monitor your investments, assess whether your diversification strategy is effective in reducing volatility and enhancing returns. If you notice that certain sectors or asset classes have grown disproportionately, it may be time to rebalance your portfolio by selling off some of the overrepresented assets and reinvesting in underrepresented ones. This rebalancing act not only helps maintain your desired risk profile but also takes advantage of market opportunities. Finally, remain open to learning and adapting your investment strategies as needed. The financial landscape is constantly evolving, influenced by economic shifts, technological advancements, and changes in investor behavior. Stay informed about new investment products, strategies, and market trends by engaging with educational resources, attending seminars, or following reputable financial news sources. Embracing a mindset of continuous learning will empower you to make informed adjustments to your portfolio and ultimately enhance your investment success. The journey to financial independence. The journey to financial independence begins with a clear understanding of one's financial goals and aspirations. It is essential to define what financial independence means to you personally. For some, it may mean having enough savings to retire early, while for others, it may involve achieving a specific net worth or the ability to travel freely without financial constraints. Establishing these goals will serve as a roadmap, guiding your investment strategy and helping you stay focused on your long-term objectives. A well-defined goal sets the stage for informed decision-making, ensuring that every investment aligns with your vision of financial freedom. Budgeting plays a pivotal role in the journey towards financial independence. It is the foundation upon which all investments are built. By tracking income and expenses, individuals can identify areas where they can save more effectively. Creating a budget enables you to allocate a portion of your income towards investments, whether they be stocks, mutual funds, ETFs, or even cryptocurrencies. The discipline of budgeting not only helps in accumulating capital for investment but also instills a mindset geared towards saving and wealth building. Effective budgeting allows for the flexibility to adjust spending habits, which is crucial when unexpected expenses arise or when market conditions change. Once you have established a budget, the next step is to familiarize yourself with the various investment vehicles available. For beginners, understanding the basics of stocks, mutual funds, ETFs, and cryptocurrencies is essential. Each investment type comes with its own set of risks and rewards, making it imperative to choose options that align with your risk tolerance and investment horizon. For instance, while stocks may offer higher potential returns, they also come with greater volatility. On the other hand, mutual funds and ETFs provide diversification, which can mitigate risk. Educating yourself on these options will empower you to make informed decisions and take calculated risks in your investment journey. Risk management is another critical component of achieving financial independence. As a new investor, it is vital to develop a strategy that balances risk and reward. Understanding your risk tolerance will help you construct a diversified portfolio that can withstand market fluctuations. This involves not only spreading your investments across different asset classes, but also regularly reviewing and rebalancing your portfolio to maintain alignment with your goals. Additionally, incorporating behavioral finance principles can further enhance your investment decisions. Recognizing common psychological biases, such as overconfidence or loss aversion, can help you remain disciplined and focused during market ups and downs. Lastly, long-term investing is key to building substantial wealth and achieving financial independence. Retirement accounts, such as 401(k), and IRAs, offer tax advantages that can significantly enhance your investment growth over time. Additionally, embracing a long-term perspective allows you to ride out market volatility and benefit from the compounding effect of your investments. Committing to a long-term
The end.
strategy.
Thank you for listening. This was a Mindful Books production. Copyright 2025.